Welcome to Griffonomics.
Glad to be here for this one. It's a wild story.
It really is. I mean, imagine someone offers you a guaranteed $30 in cold, hard cash for an asset you own.
Right, a total bailout.
Exactly. And let's say your business is, actively bleeding money. Your biggest international market just completely collapsed by like 52%.
Yeah, the balance sheet looks like a sinking ship.
Right. You desperately need a lifeline. You should absolutely take the money.
An irrational person would.
Well, today we are looking at a group of corporate insiders who looked that exact life raft in the eye, burned it to the ground, and then, and this is the crazy part, doubled down with tens of millions of their own dollars.
It is, hands down, one of the most fascinating boardroom battles I've seen in years.
Yeah.
We are unpacking the story of STAAR Surgical, ticker symbol STAA.
Yeah, CA.
And just to be clear, our mission today isn't just to, look at a standard stock chart or read off a balance sheet.
No, we're going way deeper than that.
Exactly. We are conducting a full forensic investigation into how a former hypergrowth darling crashed, attracted a massive rescue buyout from an industry giant named Alcon, and then basically became the center of a high-stakes activist turnaround play.
Okay, let's unpack this, because whether you are listening to this for the finance angle, the medical innovation, or honestly just because you love a really wild corporate drama,
Which it is.
this situation is an absolute masterclass in market psychology and contrarian investing. We are going to dig into the underlying financials, the unique medical tech that makes STAAR so coveted, and those incredibly aggressive bets being made by the insiders.
Yeah, the people who know the company best.
Right. But before we get to the financial bloodbath and that rejected buyout, we really need to understand the asset itself. I mean, what makes this specific company so valuable that billionaires are practically fighting over it?
Well, it centers entirely on their core technology. It's called the EVO Implantable Collamer Lens, or ICL. See, STAAR does not do traditional laser eye surgery. Instead, they manufacture these tiny, highly specialized lenses that a surgeon physically implants inside the eye to correct vision.
Wait, so they're putting a lens inside your actual eye?
Exactly. And the secret sauce here is a proprietary material called Collamer. It's a biocompatible collagen copolymer that is entirely exclusive to STAAR.
Biocompatible meaning your body doesn't reject it.
Right. Because it contains natural collagen, the human body doesn't recognize it as a foreign object. It's soft, it's flexible, and it doesn't trigger an immune response or cause dry eye the way, other traditional procedures might.
Okay, picture this. Imagine you have a wooden door in your house that doesn't quite fit its frame. It sticks every time you try to close it.
Sure.
Traditional laser eye surgery, like OSIC, is a subtractive procedure. It's like taking a heavy-duty sander and permanently grinding down the wood of the door until it finally swings shut.
You're literally permanently burning away corneal tissue from the eye.
Right, which works, but
It works very well for millions of people. But the defining characteristic is that it is totally irreversible. Once that corneal tissue is vaporized by the laser, you can never get it back.
STAAR's EVO ICL is an additive procedure. So instead of permanently sanding down the door, it's like installing a sleek, custom, high-tech hinge that makes the door swing perfectly into place.
I like that. You aren't removing any wood at all.
Exactly. And the best part, if your house settles a decade later, or in this case your prescription changes, you can just have a surgeon take the hinge off. It is completely reversible.
And that reversibility is a massive structural competitive moat. I mean, if we connect this to the bigger picture, the global refractive surgery market is currently undergoing this huge psychological shift.
No, totally. People are terrified of lasers.
Right. In the U.S. alone, traditional laser-based procedures have dropped nearly 40% over the past 3 years. They are sitting at multi-decade lows.
Wow, 40%.
Yeah. Patients, particularly those with severe nearsightedness, are just increasingly anxious about permanently altering their corneas. They are actively seeking out lens-based reversible solutions.
And STAAR saw that coming, right?
They did. They strategically phased out all of their legacy cataract product lines. Today, 100% of their revenue is derived purely from these ICLs. They basically transformed themselves into a pure-play specialist in a market that is rapidly moving in their exact direction.
So they have this incredible proprietary additive technology. They have a massive competitive moat. The global market is shifting toward their exact product.
Yep.
All of which forces an unavoidable question. If the technology is so superior, Why did the company's stock crash hard enough to require a rescue buyout in the first place?
Because their financials in 2025 were, frankly, brutal to look at.
How brutal are we talking?
Well, if we break down the fiscal year 2025 review, their global net sales fell 23.7%, down to $239.4 million. But the true catastrophe happened in China. Historically, China has been STAAR's absolute primary growth engine. It was the market pulling the whole company forward.
Right.
But in 2025, revenue in China plunged by 52%, dropping to just $77.8 million. And as a direct result, the overall company swung from profitability to a massive $80.4 million net loss for the year.
Wait, a 52% drop in your biggest market is staggering. I mean, did millions of people in China just suddenly stop needing glasses? How does revenue evaporate that quickly?
It wasn't a sudden lack of nearsightedness.
Wow.
While there was certainly some macroeconomic sluggishness, weak consumer spending and a depressed housing market in China make people hesitant to pay for premium elective surgery.
So people tighten their belts.
Exactly. But the real mechanical root cause was an inventory glut.
Okay, when you say inventory glut in medical devices, I'm assuming this isn't like a car dealership with too many sedans sitting on the lot. Are the medical distributors themselves getting bottlenecked?
Precisely. STAAR doesn't sell these lenses directly to the patients. They sell them to massive, independent medical distributors who buy them in enormous bulk batches.
Ah.
In 2024, those Chinese distributors were anticipating a massive summer high season for eye surgeries. So they bought millions of dollars worth of lenses.
But the patients didn't show up.
Right. When the Chinese macroeconomy slowed down, fewer patients booked surgeries. Those lenses just sat on the warehouse shelves collecting dust. So rolling into 2025, the distributors looked at their warehouses, saw they were totally full, and simply stopped placing new orders with STAAR.
Oh, wow. So STAAR had to...
To clear that clogged channel, STAAR's management had to deliberately pause their own outbound shipments. They effectively had to stop the trucks so the distributor warehouses could finally empty out.
Which means STAAR can't recognize any new revenue because they aren't shipping any new product.
And the forensic view of their financials during this deliberate pause is alarming. Analysts started referring to the company as a dehydrated engine.
Dehydrated, that's a great term.
In 2025, they posted a negative $34.2 million in operating cash flow. At the same time, their selling, general, and administrative expenses, their SG&A, ballooned to over 114% of their net sales.
Hold on, 114%. Let me do the math there. They are literally spending $1.14 just to sell a product that brings in $1.
Yes.
That is a fundamentally broken equation. How does a company not immediately go bankrupt operating like that?
That is the exact question Wall Street was asking. How do you keep the lights on when your cash flow is negative $34 million?
Okay.
The answer was a heavy reliance on stock-based compensation, or SBC.
Oh, I see where this is going.
In 2025, STAAR used $30.6 million in SBC. Essentially, instead of paying their executives and key employees in cash they didn't have, they paid them in company stock.
They were handing out equity IOUs.
Exactly, to mask the severe cash burn on their actual income statement.
Okay, so paint the picture for 2025. The stock is plummeting, the balance sheet is dehydrated, the main growth engine in China is stalled out, and they are diluting their own shareholders just to pay their staff.
I was grim.
This is the exact moment Alcon swoops in. And just for context, Alcon is an absolute titan in the traditional eye care and surgical space. They look at STAAR, see a distressed asset, and offer $30.75 a share in cold, hard cash to buy the whole company.
A huge premium at the time.
It looks like the perfect rescue. But here's where it gets really interesting. The insiders aggressively blocked the life raft.
They orchestrated a total blockade. Two major activist investors, Broadwood Partners, which owned a massive 30.2% of the company, and Yunqi Capital, holding 5.1%, rallied the shareholders to vote down the merger in January 2026.
I just can't wrap my head around that. If you own 30% of a company that is bleeding cash and handing out IOUs, why on earth do you turn down a guaranteed premium cash payout?
Well, Broadwood and Yunqi argued that Alcon was being highly opportunistic. They claimed Alcon was trying to steal a unique, world-class technology at the absolute bottom of a cyclical low.
Buying it on the cheap.
Right. But their biggest grievance was the mechanics of the proposed deal itself. They argued that the 30-day go-shop period was entirely rigged against STAAR.
Explain that mechanism. A go-shop period usually means the board accepts the $30 offer, but they have 30 days to shop the company around to see if anyone else will pay, like 35, right? That sounds like a good thing for shareholders.
It is, in theory.
Hmm.
But the activists pointed out that STAAR management was demanding highly restrictive, multi-year standstill agreements from any other potential buyer who wanted to look at their internal books.
Ah, so it acts as a poison pill.
Exactly. If a rival company wants to see if STAAR is worth buying, they have to sign a standstill. If they look at the books and decide not to buy the company right then, that standstill agreement legally prevents them from attempting a hostile takeover or even buying STAAR stock on the open market for several years.
Oh.
It essentially freezes them out of the asset entirely. The activists argued this scare tactic chased away credible bidders who might have offered significantly more than Alcon's $30.
Which led to an absolute boardroom bloodbath. The deal is killed and heads roll.
The activists completely cleaned house. The CEO, Stephen Farrell, was ousted. The board chair resigned. Neal Bradsher, who was the founder of Broadwood Partners, essentially took over the board as the new chair, expanding it to bring in his own hand-picked directors.
And this next part is the ultimate conviction signal. It's one thing to vote no and take over a boardroom. Talk is cheap. But when the Alcon deal officially collapsed, STAAR's stock valuation naturally compressed.
Right, because that guaranteed $30 buyout floor was suddenly gone.
Exactly. So Bradsher waits for the dust to settle and then drops $12 million of his fund's capital to buy 670,000 shares on the open market at around $18 a share. And Yunke Capital steps in and buys 750,000 shares at $21.53.
Which raises an important question, and it is really the crux of this entire deep dive. Why do that? When insiders, the people who see the daily sales data, the internal margins, the raw reality of the business, when they reject a guaranteed payout, fire the CEO, and then use their own capital to buy the stock at $18, they are sending a massive financial signal.
Putting their money where their mouth is.
Exactly. They are betting tens of millions of dollars that Wall Street is completely wrong. They are signaling that the 2025 crash was just a temporary supply chain friction, a clogged warehouse in China, and absolutely not a permanent structural decline of the business.
Okay, insider conviction makes for a fantastic headline, but hope is not a corporate strategy. How does STAAR actually fix the bleeding in 2026 to prove these activists right? Because you can't just buy the stock, cross your fingers, and magically fix a broken global supply chain.
No, you can't. The execution moving forward has to be flawless. And the new interim co-CEOs, Warren Faust and Deborah Andrews, have rolled out a very specific, aggressive turnaround roadmap. First, they are tackling their geopolitical macro risks head-on by attempting to completely bypass the U.S.-China tariff war.
Wait, how do you bypass a tariff war when your biggest, most important market is China?
By fundamentally changing where the physical product originates. Moving a medical supply chain is incredibly complex, but STAAR has strategically shifted the manufacturing of its China-bound lenses entirely out of the United States.
Oh, wow. Where to?
They expanded a manufacturing facility in Nidau, Switzerland. Because those lenses are now officially Swiss-made, they are completely insulated from the unpredictable tit-for-tat tariff volatility between Washington and Beijing.
That is a massive operational pivot. And they aren't just sending the same old lenses from the Swiss factory, right? They are upgrading the product line.
They are. They are rolling out the EVO Plus lens in China. This is their next-generation technology. Clinically, it features a larger optic zone, which is much better for patients with larger pupils, particularly at night.
Makes sense.
But financially, what matters is that the EVO Plus commands a higher average selling price, or ASP. By shifting the Chinese market to a premium next-gen lens, they can immediately start repairing those damaged profit margins.
And while they are stabilizing the ship in China, there is a massive catalyst happening right here in the U.S. that changes the math completely. The FDA just handed STAAR a huge victory. They officially expanded the approved age range for the EVO ICL. Historically, it was capped at age 45. Now, the FDA says it is approved for patients from 21 all the way up to 60 years old.
Which fundamentally alters their domestic total addressable market.
I mean, let's just do the math on that. Expanding that label up to age 60 instantly adds roughly $8 million potential U.S. candidates who are now legally eligible for the surgery, you are suddenly tapping into an entire demographic of older millennials and Gen Xers who are experiencing presbyopia or who are just tired of dealing with reading glasses.
That's a game changer.
It is a massive injection of potential new domestic revenue that doesn't rely on the Chinese supply chain at all.
It is a massive opportunity, but to capture that revenue, they have to survive their current cash burn rate. And that brings us to the final pillar of the 2026 turnaround plan: aggressive cost right-sizing.
Cutting the fat.
Exactly. The new leadership immediately executed a $12.4 million workforce reduction, and they impaired millions of dollars in real estate and software projects that just weren't generating returns. They are rigidly targeting a return to profitability in 2026.
But do they have the runway to actually get there?
They do. It is vital to note that despite the massive cash burn last year, their balance sheet is surprisingly resilient. They are sitting on $187.5 million in cash and cash equivalents, and they carry zero debt.
Zero debt. That's huge.
They have the liquidity to weather this transition.
Okay, so let's summarize the bull case. They have the Swiss factory dodging geopolitical tariffs. They have the EVO plus driving up profit margins. The FDA just handed them 8 million brand new U.S. customers. And they have 187 million in the bank with zero debt to fund the whole operation. It sounds like a guaranteed slam dunk.
Wall Street remains highly skeptical, though, and for very good reason. Fixing a broken global supply chain isn't free, and the competition in the medical device space is absolutely ruthless.
So what does the bear case look like? Where does this brilliant turnaround plan actually fall apart?
It starts with an accounting mechanic that analysts are calling the depreciation cliff. Remember that strategic move to build the new factory in Switzerland to dodge the tariffs?
Right. It solves the geopolitical problem.
It does. But there is a hidden severe cost to that solution. By ramping up the Swiss facility, STAAR is now running duplicate manufacturing sites, one in the U.S. and one in Switzerland.
Oh, I see.
That means lower utilization rates at both locations. You are paying the overhead to run two massive factories, but you aren't producing twice as many lenses yet. Furthermore, when that new Swiss factory officially came online, it triggered a massive sudden hit of depreciation expenses.
Because in accounting, as soon as an asset is placed into service, you have to start recognizing its loss in value over time.
Exactly. It's like buying a brand new $10 million piece of industrial equipment.
Yeah.
The moment you flip the switch to turn it on, it begins losing value, and that depreciation hits your income statement directly as an expense.
Right.
This dynamic of running duplicate factories with massive new depreciation costs is going to severely pressure their gross margins throughout all of 2026.
So the very operational pivot that is saving them from tariffs is going to eat their profit margins alive in the short term. And beyond internal accounting, that steps us right into the competitive landscape. Even if they survive this cash burn and ramp up the Swiss factory, they're stepping out of their own internal crisis directly into a buzzsaw of external competition. Let me try an analogy here.
Go for it.
It's like STAAR is selling an incredible standalone high-end digital camera. It takes the absolute best photos in the world. But their competitors, like Alcon and J&J, are selling the entire Apple iPhone ecosystem.
That is a perfect way to visualize the mechanism of medical sales. The Apple ecosystems in this scenario are the massive conglomerates, Alcon, J&J, and Zeiss.
Because those giants don't just sell the lens, they sell the whole operating room.
What's fascinating here is how entrenched these systems become. Alcon and J&J sell full-suite surgical ecosystems. They sell the initial diagnostic machines, the surgical lasers, the monitors, and the proprietary software that connects every single piece of equipment together.
It's all integrated.
Exactly. When a hospital or a private surgeon buys into that ecosystem, they are deeply locked in. Their staff is trained on the software, the hardware communicates seamlessly, and they often get bundled financial discounts. It is incredibly difficult for a specialized boutique like STAAR, who only sells a camera lens, to convince a surgeon to step outside of that massive, integrated ecosystem they've already spent millions of dollars building their practice around.
Even if the standalone lens is technically superior, the friction of leaving the ecosystem is just too high for a lot of doctors. Plus, STAAR isn't just fighting the giants above them, they're facing intense pressure from the bottom up. Cheaper Asian competitors are starting to flood the implantable lens market.
Yes, companies like Biotech Vision Care and Eyebright are entering the space. Now, they don't have the proprietary biocompatible polymer material that STAAR has, but they are offering lower-cost acrylic and silicone lenses.
So STAAR is violently squeezed in the middle.
Exactly. Fighting the deep-pocketed, locked-in ecosystem giants above them and the low-cost budget copycats below them.
So what does this all mean? We've looked at the broken engine, the inventory glut, the activist takeover, the turnaround plan, the depreciation cliff, and the ecosystem lock-in. Where we land.
If we synthesize all the source material, this situation represents the ultimate insider arbitrage. Analysts are rating the strategic outlook here as high H alpha, but incredibly volatile.
Alpha, in Wall Street terms, being the excess return you earn on an investment above the broader market average.
Right. It's the reward for being right when everyone else is wrong.
Yeah.
And it all comes down to one massive concentrated bet. The activist investors who now control the board are wagering their reputations and tens of millions of dollars that the market panicked. They believe Wall Street mispriced a temporary, albeit severe, inventory pause in China as a permanent structural decline of the business.
And for you listening, whether you are evaluating your own investment portfolio, assessing a distressed competitor in your industry, or just trying to understand market overreactions, the real lesson here is about diagnostic clarity. It's about learning to distinguish between a fundamentally broken engine and a temporary traffic jam. The broader market saw the stock price drop, saw the negative cash flow, and assumed the technology was dead. The insiders looked at the exact same data and saw a clogged supply chain that just needed a strategic pause to clear out.
Which raises a final critical question to ponder as we watch this turnaround play out over the next year.
What's that?
As medical technology continues to advance, will the future of elective surgery be dominated by massive one-stop shop conglomerates that lock doctors into rigid hardware ecosystems? Or is there still room in the market for the highly specialized, pure-play innovator who just does one thing, like making the perfect reversible Collamer lens better than anyone else in the world?
It's a billion-dollar question, and Neal Bradsher just bet $12 million of his own money that the innovator wins. Risk defined, portfolio protected,